Every episode of this series has built toward one question. In episode 4, we mapped the volatility surface, the 3D landscape of implied volatilities across strikes and maturities. In episode 5, we built the Heston model, which generates that surface from stochastic variance. Both episodes ended with the same implicit question. If you believe the surface is telling you something, if you have a view on future volatility, what do you trade? If your answer is options, you face an immediate problem. An options position carries directional exposure, delta. You need to hedge it continuously, and every hedge is imperfect, path-dependent, and transaction cost-bearing. The P and L of a delta-hedged option does not isolate volatility cleanly. As Dimitrov, Derman, Kamal, and Zhu put it in 1999, a replicating portfolio for a variance swap would require an entire strip of options, which would be costly to execute and would need to be rolled regularly. The variance swap solves this. For an end user, it is one of the cleanest institutional instruments for trading realized variance. The final payoff is based on variance, not the terminal direction of the index. You are not managing a daily delta hedge yourself. One payment at expiry based on one number, whether the market moved more or less than what was priced in. Variance swaps. Trading realized variance without a directional bet on price direction. A variance swap is a forward contract on realized variance. Two parties agree on a number, the variance strike, at inception. At expiry, whoever was right about whether actual volatility came in above or below that number gets paid. The loser pays. No asset changes hands, no delta to manage. Just a cash settlement based on one comparison. The party who is long the variance swap receives realized variance. The party who is short pays realized variance and receives the fixed strike. If realized variance exceeds the strike, the long makes money. If realized variance comes in below the strike, the short makes money. That is the entire structure. The settlement payoff at expiry is variance notional times realized variance minus strike variance. Now make it concrete. You sell a one-year variance swap on the S&P 500. Vega notional is $100,000. The volatility strike is 20, meaning 20% annualized volatility. The variance strike is 20 squared, or 400. Variance notional is $100,000 divided by 2 times 20, which equals $2,500 per variance point. Your bet is that realized SPX volatility over the next year will be below 20%. Calm markets pay the seller. Severe stress pays the buyer, and the payoff grows quickly because the contract pays on variance, not volatility. If realized volatility is 15%, realized variance is $225, and the seller receives about $437,000. At 20%, the trade breaks even. At 40%, the seller pays about $3 million. At 60%, the seller pays about $8 million. That table is the whole economic story. The convexity is the key observation. From a 20% strike, realized volatility at 40% produces a $3 million payoff to the long. Realized volatility at 60% produces an $8 million payoff on the same notional. The payoff does not scale linearly with volatility because the contract pays on volatility squared. Being short uncapped variance means selling an instrument whose buyer benefits disproportionately from volatility spikes. Variance swaps existed before 1999. UBS dealt the first one in 1993, but there was no clean answer to the question, what is the fair strike? Without a replication argument, pricing was model-dependent and hedging was imprecise. In March 1999, Kresimir Dimitrov, Emmanuel Derman, Michael Kamal, and Joseph Zhu at Goldman Sachs published a research note titled More Than You Ever Wanted to Know About Volatility Swaps. Their central result was that, in the continuous path idealization, with a full strip of European options and frictionless trading, a variance swap can be replicated using options across strikes. The key insight comes from Ito's lemma applied to the log of the asset price. Under geometric Brownian motion, realized variance over a period equals approximately twice the P and L of being continuously long 1 over S units of the asset, minus twice the log contract. The log contract has a curved payoff. Dimitrov and co-authors showed that any twice continuously differentiable payoff can be replicated by a portfolio of options across all strikes. For the log contract specifically, The replicating portfolio has a weight proportional to 1 over K squared on each option at strike K. This means that to replicate a variance swap, you hold puts and calls spanning all available strikes, with each option weighted inversely proportional to the square of its strike price. Lower strikes receive higher weights. Very high strikes contribute very little. The weights look like a downward-sloping curve when plotted against strike. Using this replication, and assuming continuous paths, no frictions, a continuum of European strikes, and a pivot at the forward, the fair variance swap strike is the variance level at which both parties break even. This connection is precise, but not literally 1-to-1. The VIX is designed to represent the market's 30-day risk-neutral expectation of SPX variance, quoted as annualized volatility. The square of the VIX is therefore an approximation to the 1-month variance swap rate on the S&P 500. When you look at VIX equals 20, you are reading that the market-implied 30-day variance is approximately 400 variance points. If variance swap pricing were purely actuarial, if the fair strike simply equaled the market's best estimate of future realized variance, then being long and short variance over time should break even in expectation. But the data shows something different. Carr and Wu documented that across 5 major stock indices and 35 individual stocks, from January 1996 to February 2003, the variance swap rate systematically exceeded subsequent realized variance. The implied variance was consistently above what actually materialized. This gap is the variance risk premium. Using more recent data, one public Sharpe-2 sample reported that SPY 30-day implied volatility, proxied by VIX, exceeded subsequent realized volatility approximately 78% of the time from September 2025 to March 2026. Treat that as indicative, not the core proof. The stronger evidence is academic. Boleslav, Tauken, and Zhou showed that the variance risk premium has economically meaningful return predictive power at quarterly horizons, with a simple quarterly R squared of 6.82% and higher explanatory power in multivariate specifications. The premium is not just chart noise, it is a priced risk transfer between hedgers and volatility sellers. The persistence of the variance risk premium has 3 explanations. First, options are priced to cover sudden large moves. The static replication only works cleanly when prices move continuously, and jumps create unhedgeable payoff gaps. Second, portfolio managers systematically buy protection against volatility spikes, pushing implied volatility above actuarial pricing. Third, investors empirically overweight extreme outcomes relative to their actual frequency. Brody and Jane show that jumps and discrete sampling add a systematic premium to variance swap pricing. Boleslav, Tauken, and Zhou connect the premium to return predictability rather than pure noise. Carr and Wu document the same broad pattern across indices and individual stocks. Different papers emphasize different channels, but the same economic point keeps appearing. Someone is paying to transfer crash variance risk. The VRP is not a guaranteed free lunch. The premium is exactly compensation for the risk of catastrophic losses. On November 20th, 2008, VIX closed at 80.46, the pre-COVID closing record. SPX realized volatility in Q4 2008 was approximately 60 to 70% annualized. In March 2020, VIX closed at 75.47 on March 12th, then set the current closing record of 82.69 on March 16th. And in August 2011, VIX spiked above 48 during the U.S. debt ceiling crisis and European sovereign debt fears. These are the environments where short variance can give back years of premium. A volatility swap pays the difference between realized volatility and a strike. It is clean, intuitive, and linear in volatility. A variance swap pays variance notional times realized variance minus strike variance. The payoff is linear in variance, but convex in volatility. This convexity is not incidental. It is the reason variance swaps dominate in practice over volatility swaps. The convex payoff is a direct consequence of the replication by a log contract, which is why variance swaps are priceable in a model-free way under the ideal assumptions. The Equicurious Derivatives Guide states the paradox precisely. Volatility swaps are harder to replicate and therefore less liquid than variance swaps. The simpler payoff is not easier to hedge. The reason is that variance swaps have a clean, model-free replication through the 1 over K squared option strip. When a bank sells a variance swap, it has a transparent hedge. Buy the weighted strip of puts and calls, hold it statically to expiry, and continuously delta hedge the residual. Volatility swaps require hedging the square root of variance. That nonlinear function does not have a clean model-free replication. Dealers need assumptions about the volatility process, which means model dependence, wider bid-ask spreads, and less willingness to make markets. But the variance swap hedge has an honest limitation. It assumes continuous paths, a full option strip, continuous monitoring, and no trading frictions. The most important failure mode is jump risk. In crisis conditions, jumps dominate. The practical consequence is that the variance swap strike is slightly higher than the theoretical replication would suggest, because dealers charge a jump risk premium for bearing the unhedgeable gap. Ian Martin wrote that the no-jump assumption failed badly during the financial crisis of 2008 to 2009. Carr and Lee made the same point from the dealer side. The standard theory was not nearly as model-free as previously supposed. That does not destroy the variance swap framework. It explains why the market charges for the part that the clean formula cannot hedge. In traditional equity markets, the VIX is best read as an annualized volatility quote for the 30-day risk-neutral variance implied by SPX options. A related construction exists for Bitcoin and Ethereum on Deribit, expressed through the DVOL index. Deribit's methodology document states directly that DVOL is constructed in the same manner as the more well-known VIX. It uses the implied volatility smile of the nearest expirees to output one number representing 30-day annualized implied volatility. The key difference is that BTC DVOL runs structurally higher than VIX. Over 2024, BTC DVOL ranged approximately 40 to 80% versus SPX VIX in the 12 to 24% range. Economically, that makes DVOL close to the square root of a 30-day variance swap style rate on Bitcoin or Ether, subject to Deribit's filters, interpolation, and smoothing rules. As discussed earlier in the series, crypto order flow can be much more toxic than equity index futures flow, so higher absolute implied volatility is not surprising. A larger crypto variance risk premium is plausible, but it should be treated as an empirical hypothesis unless it is backed by a dedicated DVOL- realized dataset. One caveat matters. While variance swaps on equity indices are liquid OTC instruments used by institutional desks globally, crypto variance swaps remain thin and primarily institutional. The DVOL index gives traders a window into the fair variance strike, even when they are using options rather than swaps. 5 things are worth keeping. First, a variance swap gives clean, realized variance exposure. The payoff is tied to realized variance, not market direction. Second, the 1 over k squared replication is why the instrument prices cleanly. Third, VIX is an approximate 30-day risk-neutral variance quote. Fourth, the premium is real, but it is compensation for tail risk. And fifth, the convex payoff means volatility spikes dominate the economics. None of these points is a recommendation to be long or short variance. They are the mechanics. Once you see the payoff, the replication, the premium, the jump risk, and the VIX connection, the instrument stops looking mysterious. It becomes a precise way to transfer one very specific risk: how much the market will actually move. We have built the variance swap from scratch. We have seen how it prices through replication, how the volatility risk premium makes it attractive to sellers, and where the model breaks down in the presence of jumps. There is one thing we have used in this episode but not fully dissected: the VIX. We said it is approximately a variance swap rate. We said it uses the 1 over k squared option strip. But the full construction, how CBOE computes it, what the discretization error means, how VIX futures price relative to the index, and what the VVIX tells you about the VOL of VOL, none of that has been shown. Episode 7. This video is for educational purposes only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy, sell, or hold any security, derivative, or financial instrument. Variance swaps are sophisticated OTC instruments used by institutional market participants. The worked examples use simplified assumptions for mathematical illustration. Historical VRP data cited from Carr and Wu, Bullerslev and co-authors, and recent public data sources. VIX records are confirmed by CBOE. Past behavior of implied versus realized volatility does not guarantee future behavior. Always conduct your own research and consult a qualified financial professional before any investment decision.